Hi everybody. Hopefully this is gonna work. I haven't recorded a video in a while, but we'll give it a shot. Anyway, I was gonna review the PowerPoint real quick. I only have 15 minutes on this thing, so it's gonna be pretty short. I did attach another PowerPoint or video to help you do your homework, so be sure to watch that. So I'm gonna zip through a few things here. A couple things that you need to remember. Two things. Remember, I already talked about this, but I'm just telling you because it's going to help you. Remember that merchandise inventory. So this is chapter 9. We're talking about like operating a retail business. So merchandise inventory is an asset. So when you purchase merchandise inventory, it would be debit. So it's items that you have to sell. Cost of goods sold is also a debit. Don't ask why, I don't have time to explain it, but just remember, and it's abbreviated COGS, cost of goods sold. So that is also going to be a debit, okay? So remember when we calculate gross profit in a retail business, they give the example of Walmart. You're gonna start out with your revenue, which is, we're already familiar with that. That's money coming into your business. And we're gonna subtract the cost of goods sold, and that's gonna give us your gross profit on sales. And then really, if we want to look at where your true profit is, we have to take into consideration some other things like operating expenses. But first, this is a key slide, so you might want to remember it. It's going to be slide number 6. So from an accounting standpoint, Walmart sales revenue, sales is going to be a credit, just like always, we learned that. Your customers have two ways to buy things from you, either cash or accounts receivable. So that would be your debit. Okay, so that's one transaction. And from now on, when we do these transactions, you're going to need to do a total of 4 entries. So one is for the product that you sold. The second one is to journalize how much it cost you. So that's this part here. Cost of goods sold is going to be debited, and then your merchandise inventory is going to be credited. Merchandise inventory is going to be credited. Okay, cost of goods sold is how much your inventory cost you. So your inventory is decreasing, your cost of goods sold is increasing. Okay, so then if we do that, then we can get our gross profit, and then we subtract our operating expenses like we learned how to do in a net income statement, and that gives us our net income or net loss. We already kind of talked about that. Okay, so, I can see I'm not looking too good here. So that is how we're going to journalize a situation like this. So this is what your homework's like. And I did it on just the regular spreadsheets. So you'll have a chance to, take your time without a lot of guessing. So let's say on July 9th, Walmart bought a flat screen from Sony for $7,000 on account, bought flat screen TVs on account with terms 2/10 and 30. So we already went through this a little bit in class, but I'm just reviewing because it was a while back. So Walmart bought $7,000 worth of televisions. They bought them on account, so that's account payable. So that is how we build our inventory in the business. Okay, pretty simple. I don't think that's really that new. Okay. And then they just warn you that not all purchases go to merchandise inventory. If you buy things for your business, like supplies, or in this case, shelving equipment, you can either pay cash or you can buy it on account. That's nothing new. We've already learned that. Okay, so now if we go ahead and sell our inventory, we have to, This is when we have a return. So I went through this already, but I'm just reiterating. So a damaged TV was noticed, and the company issues a debit memorandum. Remember, it's called a debit memorandum because your accounts payable is debited, because you give the TV back to Sony. So you're Walmart, you're selling TVs, one's broken, it goes back to the supplier. And so that has to be taken off of your accounts payable. You no longer owe money for it, and it also decreases your merchandise inventory. So that is on the buyer side of things. So just keep that, one more thing to remember. Okay, and then the other thing they're talking about here that really doesn't have a lot to do with your homework is this idea of a discount. So I'll go through it pretty quickly. I have enough time. So remember that a supplier like Sony will offer Walmart a discount in turn to incentivize them to pay quickly. So when they do that, we have to keep track of that discount. So in this case, the discount was back here on this slide right here. It's kind of tricky. It's 2% if they pay within 10 days. The net is due in 30 days. Okay, I already showed you that once before, but I'm just going over it again. So in this case, you have your accounts payable, all the TVs that you bought, less the one you sent back. You're going to pay it, so your cash is credited, and you're going to take the discount. And the discount is recorded as a decrease in merchandise inventory. So that is something that you're going to have to, you're going to have to refer back to the PowerPoint. You're going to have to write notes and remember it, however you want to do that. That's going to come up, and we're going to have to review it because it's a little bit tricky. But this is when Walmart wants to pay back the supplier, Sony. And then they show you how they calculated the discount there. Okay. So then the next thing, which is part of your homework, is recording the cost of freight. And they do a pretty good job of this in the little video that I showed, that I attached. So a lot of times the buyer can be responsible for the cost of freight, especially nowadays. Freight's expensive with the price of diesel. So that cost of freight is added to the cost of merchandise inventory, which makes total sense because as a retailer, that is, the thing that you have to sell. So you're including its freight costs in what it costs you to put it on the shelf. So merchandise inventory is $300, and in this case, they paid the freight with cash. They didn't pay it on account payable. It was just paid with cash. And remember, it says that it's paid by the buyer here, and that's usually how it's going to be in the homework too. So freight is going to increase the cost of merchandise inventory. Okay, so now we're going to do what your homework shows, which is how you're going to record sales revenues. So remember that there's going to be a total of 4 entries, 2 transactions, 2 debits, 2 credits. So 4 total entries. So when we do perpetual inventory, at the time of the earned sale, the seller, that's going to be Walmart, will do the following. You record the sales, and you will record that as sales and either cash or accounts receivable. And then you also have to record the cost of the goods sold and the decrease in inventory. Okay, so let's take a look at that. So here it is. This is what your homework's like. So following is an example of the sale of a TV for $950 on credit to customer Jones on August 10th, which cost the seller $600. Okay, so here's the 4 transactions. This is like your homework. So what do you have to do? Well, remember, he bought the TV on credit. You are going to put that as an account receivable, and you're now going to put the name of the customer because that's going to be important for the later on in this chapter because we're going to we're going to keep track of who owes us money. So accounts receivable, customer Jones, bought a TV for $950, and then that's going to be sales, which is our revenue account, and that's going to be credited. Okay, that's something we've already learned, maybe a little bit different because we're actually recording who is buying from us. Okay, now in addition, once we sell that TV, we have to record it in our inventory. So our cost of goods sold, the cost of one TV was $600. So that's going to be debited because we need this cost of goods sold to figure out our profit. And remember, it's always debited. And in our merchandise inventory, we sold a TV, so we have $600 less inventory. So that's credited. So remember, merchandise inventory, when you buy it and put it on the shelf, it's an asset, so it's a debit entry. As you sell it off, it's credit, credit, credit until you don't have any left. So that is a good example of what you're going to be doing in your homework. And then they're going to go through a couple of other little bit more complicated scenarios. But this slide right here is slide number 13. And it's reviewed pretty good in that practice video. Before you do your homework, I would strongly recommend you doing that. Okay, so let's look at this idea sales returns and allowances. So this is on the seller side, not the buyer. Remember, Walmart is a buyer from Sony and it's a seller to customers. You got to think about how business works. So the account they want you to learn about is called sales returns and allowances. This is a contra revenue account. It counts against your revenue because when people bring things back, it decreases your sales revenue. So that's why it's called a contra revenue. If it's a contra revenue, that means it will always be debited because it goes against revenue. Revenue is always credited. So here's an example of this customer returns his $950 TV that he purchased on account. So how do we record this from an accounting standpoint? Well, we don't want to just put it back in merchandise inventory because we have to record what we sold it for. So that's where our sales returns and allowances comes in. So that's a contra revenue. So that is going to be a debit entry. And then we have to reverse his accounts receivable. So he charged it. This was a different guy. He charged it. He brought it home. He didn't like it. Brought it back. Bought it on account. So we have to even out his account. And so we're going to credit his accounts receivable. Okay, so that's his first step. Now we have to go back to our inventory, take it out of or put it back into our inventory. So it's debited, putting it back, they brought it back. I mean, you're not going to really put it back, it was damaged, but we're going to put it back at the cost that whatever we bought it for. And then we have to credit our cost of goods sold because we did not get that money. They brought it back. So not only do we have to justify the customer's accounts and our sales revenue account with that contra revenue, but we also have to adjust our merchandise inventory. Okay, so that's a little bit challenging, but we're just going to practice it for a while till you get it. So remember, we're doing a total of 4 entries or 2 transactions for and 1 event in a business. Okay, now they're finally going to talk to you about this idea of discounts. So discounts are really important in the big world of accounting. They really are. Because, a small vendor can save a lot of money if they can pay their bills a little bit early. So the way a discount works is if I have customers, I am selling TVs, and they are buying things on account, I will give them a discount if they pay within the first 10 days of the date on the invoice. So the invoice is like a bill, whether it's emailed or mailed by a stamp, it's still the date of the invoice. And so you can take a 2% discount, which means you don't pay the full amount back. It's just the same as what I showed you when you, as Walmart, are buying a TV from Sony, but that's a buyer's discount. Okay? So the credit period is the length of time allowed to pay the amount owed on the bill. That is, by law, has to be 30 days. The sales discount is another contra revenue. So sales discount is a contra revenue because it counts against your sales, right? You're going to get less money, but they're going to pay you faster. So that is why you would do a sales discount. And that is done all the time in, the big world of business. I only have about 2 more minutes left, so we're going to be finishing up here. So how do you record that sales discount? Well, in this case, your customers came in to pay you. They're paying off their account receivable. They pay you in cash, but they take the discount. So instead of paying you the full amount, they're only paying you $931 because they took the 2% discount, which amounts to $19. So we have to keep track of that. And that is a special account, just so we know what we sold on that discount, because it's kind of like it's gonna decrease our sales revenue. That's okay. And then we are going to credit their accounts receivable for the full amount because they no longer owe us that money. Okay, I think I'm gonna have to call her quits because I only have about 30 seconds left. All right, I will see you guys on Thursday.